But yeah, did you see Chipotle like do a share split this morning, like 50-1?
I saw, I saw something about
Yeah,
that, and then I
yeah,
saw the stock price up pretty bigly.
right. Yeah,
Oh,
yeah. So yeah, we back to
oh, it
that
is up a
period again.
bit. Yeah, yeah, we're back to that
One,
stock
two,
price.
three, four.
All opinions expressed by Chris, Michael, Zach, and their castmates are solely their own opinions and do not reflect the opinion of 5i Research. This podcast is for informational purposes only and should not be relied upon for any investment decisions. Employees of 5i Research may hold positions in the securities discussed in this podcast.
Welcome to the fourth episode of The Exponent with 5i Research. My name is Chris. I'm a senior investment analyst with 5i, and I want to welcome you, our listeners, to our journey into the heart of the Canadian markets. Our mission is to empower investors with precise insights and in-depth research into stocks, the economy, and more. With that said, let's dive into the Canadian and U.S. financial landscape. So today I'm joined by my co-host, Michael. Welcome, Michael.
Oh yeah, thanks for having me.
Yeah.
And
Um,
yeah, today we gonna talk about like some Canadian small cap names and a quick research on what we have done on investing in stocks at their 52 weeks high, and also some Canadian stocks that we think Warren Buffett would be likely a buyer of, and our latest service at 5i, also some notable earning release that the companies that we follow.
Yeah, no, definitely. It's a good summary to what we're going to be talking about for this episode's monthly roll up. So, with that said, I'll start off with the first one here. So, the first topic that we're talking about is the case for buying at 52-week highs. So, this is an in-house piece of research that I've done, and it's essentially looking at buying stocks at their 52-week highs and why that's typically better than waiting for large pullbacks to buy. And I'm going to put a chart up that includes my analysis. Here is an analysis that I've done on all 500 companies in the S&P 500 index. And in this first graph, what I've shown is that on average, stocks tend to be closer to their 52-week highs than not. So for example, 33% of the time since 1980, the S&P 500 stocks have been within about 5% of their 52-week highs. And overall, just over 50% of the time, they're within about 10%. So that's combining the 33% and 19% figures. And so basically it's saying more likely than not, investors will see stocks closer to their 52-week highs. So when, as investors, we see stocks hitting their 52-week highs, it really shouldn't come as a surprise. And it shouldn't be a reason for us to shy away from those names. And I think this is particularly important as we're entering a period where stocks are at their all-time highs. We're seeing more often stocks hitting their 52-week highs. And so the data kind of shows that it's not necessarily a means to sell a stock or to shy away from buying a stock, because the data shows that, on average, stocks are going to be closer to their 52-week highs than they won't be. And large pullbacks, like those 50+% ranges that we're seeing, those happen very rarely. We can see it happens like 2% on average of the time since 1980 that you see a 50% drawdown. So it's pretty rare to see those occurrences. And then on the next slide, going off of that, what I've done is I've analyzed the price CAGR of the S&P 500 stocks since 1980 for different groups of stocks that have made more 52-week highs relative to 52-week lows. So in essence, like as we move to the right side of this chart, that includes stocks that on average made more 52-week highs than 52-week lows. And as we go to the left side, that's stocks that we're making more 52-week lows relative to 52-week highs. And then the bars indicate, the height of the bars indicate their price CAGRs or annualized price returns since either inception, like IPO, or since 1980. And so what it's demonstrating is that, stocks that make more highs relative to lows on average have the best price returns over time. And intuitively, that might make sense that, of course, a stock that makes more highs than lows is going to have a better annualized price return. But really demonstrating that through data, we can just see that, you know, really it's usually better to buy stocks that are hitting their highs versus not, because it indicates companies that are probably doing something right at the company. Fundamentals are likely growing, financials are doing well, and these are the stocks that have had the best returns over the years. So fundamentally, it makes sense. And then just through data, we can also see that buying stocks that are hitting more 52-week highs is historically better than buying stocks that make new lows. So that's a little piece of research that I've done. This is available for premium 5i users, but this is just a little piece of some of the data that I've done, and just kind of indicates why buying at the 52-week highs actually makes a lot of sense.
Yeah, sure. Yeah, it's a good piece of research. Yeah, I also think that although it is a bit like psychologically challenging to buy
Mhm.
like stocks at 52 weeks high, because investor feels like they may overpay a bit, but
Right.
like winners just keep winnings, and great
Right.
companies will most likely stay at their highs than their lows, and just keep riding to new highs. And if investors are worried like CSU are trading at highs, like they miss like multiple backers all the way,
Right.
like
Right.
uh,
Yeah. No, that's such a great point. Yeah, I really like that saying of, winners keep winning. Um, it's kind of in line with this other quote that I've, ascribed to over the years, which is, the trend is your friend. If something's moving up and to the right, you kind of want to just follow the trend and stick to that. So definitely, no, that makes a lot of sense. Thanks for the commentary there. Um, yeah, so then that's the case for buying at 52-week highs. Next we're kind of looking at Canadian small cap names. So Michael, do you want to start off with the name that you have here?
yeah, sure. So today we gonna talk about small cap names that started to get some interest from investor recently. The name of the company is Vitalhub. Ticker is VHI. It is a healthcare and service provider, serial acquirer. And in the last few years, the business has accelerated its top line growth meaningfully through their acquisition strategy. And in the most recent quarters, their revenue growth was 35%, and EBITDA growth was almost 111%. So really strong, resilient business there. This is a highly recurring, predictable business model, software-like, with a gross margin of 80%. The market cap is still relatively small, under 300 million Canadian dollars, which is still quite underfollowed. And the share price just keep grinding new 52 weeks high recently with solid momentum. And one of the key catalysts is share count was actually under control this year as the company stopped issuing shares and started to grow
Mm.
really through internal cash flow. And the management said they only acquire assets that are capital light and high margin and very recurring revenue in nature. Valuation is not cheap though. It is trading at 28 times EV to EBITDA, and while CSU is trading at like 29. But this could turn out to be like a good investment if the company can sustain this kind of growth of like 30% plus in the top line.
Nice.
Yeah.
Yeah, no, definitely VHI. It's certainly coming up the ranks recently. We've been hearing a little bit more about it. And like you were mentioning, yeah, I mean the price chart is just certainly like up and to the right since really the fall of last year. And also looks like they have earnings coming up soon. And it's an interesting point you made about, they're not issuing shares anymore, and so they're kind of halting that. It's surprising how much of a difference that can really make. I think that's something that kind of goes overlooked at times where, just stopping share issuance can really have a positive impact on share price. So, yeah, really interesting name there.
Yeah, sure. Yeah, for example, like CSU, they never issue another share in the last
Right.
since going public. So like for companies
Crazy.
that value their shares like gold, like the
Right.
investors will
Right.
do the same thing. Um, yeah,
Yeah. It's really like, it's just having that mindset of, looking out for the investors and being really shareholder friendly. So,
yeah,
um,
definitely.
yeah,
Yeah,
we've seen that common theme really play out well for stocks. So, definitely something for investors to kind of keep an eye on is that that's so important when looking at management teams and what kind of company one's investing in is looking at those shareholder friendly practices. Yeah.
yeah, definitely. Yeah.
Nice.
And how
Awesome.
about you, Chris? What name is on your under your radar recently?
Yeah.
Uh,
Yeah, definitely. So I'm going to add my slide to the screen. So my name is Converge Technology. The ticker is CTS. And so this is one that we cover at 5i Research. We've covered it for some time now. And so CTS is a North American IT services company that specializes in digital transformation, cloud solutions, and managed services. They cater to enterprises, government agencies, and small and medium sized businesses. And they benefit from a shift towards digitalization and migration to the cloud. Um, it does have some exposure to AI. So it has an advanced analytics and AI practice. And recently, it's been really showing some strong earnings results. In its most recent quarter, its sales growth was kind of slow, but profits and margins are really strong. It's been buying back some shares, about 1 to 2%, and it trades at a cheap valuation. It's at about 10 times forward earnings right now. Momentum's improving, and overall, I like this name going forward. And on the chart, we can see its free cash flow expanding. So the gray bars there, that's the free cash flow over the last 12 months per quarter. And then purple line, that's the price chart. And so we can see its free cash flow has really just been exploding higher there recently. And its share price is kind of taking note of that and increasing alongside it. And so, its sales growth was somewhat slow in the most recent quarter, but overall, it's still growing at about 20+% on an annualized basis. And so, for a small technology company with decent sales growth of about 20%, and it's also looking at, growing its margins in the coming years. It's a pretty attractive name at a 10 times forward earnings basis. So, so I certainly think that we could see this one continue to expand its momentum here and continue higher into the next coming years.
yeah, sure. Yeah, I agree. It looks attractive to me, like trading at 10 times and growing
Yeah,
20% plus. Yeah,
yeah,
definitely should be on your watch list.
yeah.
Um,
No, definitely. Yeah, it's yeah. I think it was one of those names that probably got oversold in the 2022 kind of bear market. Like sentiment just kept driving it lower. Um, Investors just kind of sold it off and basically wrote it off as probably being worthless. And then, I think we'll see more of these tech stories kind of recover and rebound in the coming years as like, business activity recovers a little bit. So, so definitely, yeah, could be a name to keep on one's watch list for sure.
yeah,
And then next up, we're going to be talking about our latest service at 5i Research. This is the macro market models. And so it's available exclusively for portfolio analytics users. We do have a lot of public information on these models. Investors can find a webinar. I'm going to be pasting that webinar into the show notes. So feel free to check out that webinar that I've done. And I'm going to add what the macro market models look like to the screen here. So, these are in-house models that I've created for so far the S&P 500 and the TSX, and it aims to provide investors with a general framework for thinking about aggressive or conservative positioning within the markets. We are looking We are looking at expanding these models into other markets, but for now, we just have the S&P 500 and TSX. And so it's really looking at if investors should feel comfortable or maybe pessimistic about the markets. The models generate 5 main market signals that have demonstrated high correlation with forward returns historically. So the models aren't really intended to be used as like discrete buy or sell signals. They're not like a trading tool, but rather it should be a framework for looking at one's portfolio. And so here I have the S&P 500 model. You can see that I've obscured the last 8 months worth of data. So those dots are grayed out. But we have the model signals for all other data points dating back to roughly 1990. So dark green is a very strong buying opportunity. That really only happened at the bottom of 2009. And then dark blue, that strong buy. We can see this really happens at major market bottoms. So 2003, 2009, 2020. And we actually had a few dots recently in March 2023 with the US regional banking crisis. Then light blue, that's buy. That's going into a major market bottom and coming out of one. And we can kind of see that that's where we're at, at the last data points here. So in roughly the bottom of 2022 and into 2023, that was a buy signal there. And then orange, tactical buy / hold. That's really like late stage bull cycle. So, as it's coming out of the correction and the bull market is continuing. And then red is trim. That really occurs at market tops. So we can see 2000, 2008, and then 2021, some clusters of red dots there. Now, looking at the TSX, we have the exact same signals, with the exception that the TSX actually never hit its very strong buy dark green signal. But that could still happen in the future. But we do have every other signal there. Again, dark blue happens at market bottoms, light blue into them and coming out of the bottoms. Orange is tactical buy hold. That's kind of late stage bull cycle. And then red is trim. That happens at market tops. So those are kind of a glance at the different models. Portfolio analytics users get access to various different other charts and insights. And so, if you're a listener or a viewer right now, and you're not a member and you'd like to sign up, you can head to our website and sign up directly for a portfolio analytics subscription to get access to these. And if you're a basic member and you'd like access, you can upgrade by going to manage my subscription and then upgrading to portfolio analytics. But I'm sure we're going to be having some more updates on these in the coming months. So, feel free to check on our YouTube channel for some, future videos that we're going to be doing as well. But yeah, that's a little look into the macro market models.
Looks like a great model for me too. Yeah, because it says investors, like we don't know where we're going, but we should have an idea like where we are. And it should not be like all cash or all equities. And so, but have an idea of where we are should allow us to position our portfolio, whether to be more aggressive or defensive, more cash or less cash, etc. So I think this model should definitely help on that part.
Yeah, no, definitely. That's a great way of phrasing it. So, that's precisely it. It's kind of looking at positioning and not exactly, as soon as the dark blue hits, like, buy everything with, both hands, but like kind of, phasing into a more aggressive positioning in the markets or, red is kind of looking at getting into defensive sectors. So yeah, you hit the nail on the head for sure. No, that's great. Thanks for that. I'm going to remove that now. And then I think, Michael, you have a section here that you're going to be talking about. So why don't you intro that one for us?
Yeah, sure. Definitely. So I think one of the topics that investors are particularly interested in is like what Canadian names would be qualified as Warren Buffett's long-term holdings. And so just want to briefly go through some of his key criteria for stock selection. He pretty much likes simple and predictable free cash flow generative businesses with a very, very strong balance sheet and well run by a shareholder-friendly management team. that consistently demonstrated the track record of repurchasing shares or raising dividends over time. And he preferred buybacks than dividends, and the threshold he usually looks for is companies that repurchase at least 5% of their shares outstanding each year. And also, last but not least, he really liked business with a strong moat that makes it hard for competitors to replicate or to compete with the companies. And by applying that filter, I got 4 names. So first are the railroads. Everyone knows Buffett's really a huge fan of railroads. He owns one too. And the second one is Canadian Natural Resources. The ticker is CNQ. And the next one is an IT service company, GIB. Doc A is the ticker. And the common theme among these names is really like they generate very healthy free cash flow, and they return most of them back to shareholders through aggressive buyback. And these businesses have pretty much been around for many decades, and will expect it to be continue to be great businesses going forward. These companies also possess decent competitive advantages, whether it is brand name, scale advantages, or high switching costs, etc. And overall, these are very high quality and very durable assets. And we think these companies would likely continue to be great investments over the long term. Yeah.
Nice. Yeah. Yeah, no, definitely. That looks like a good list of names, and certainly names that have been around for a long time. And, CGI is one that we've definitely been a fan of at 5i Research. And, it's interesting you mentioned, that these are companies, growing their free cash flow, distributing out some of that free cash flow in the form of, dividends or share buybacks. And I think it, goes unnoticed sometimes by investors looking at free cash flow versus, net profits or earnings per share, just because of those, accounting differences. But, it's super useful looking at free cash flow. Just kind of strips out all of the accounting one-offs and things like that can be kind of added to in an income statement. But yeah, it's super important looking at free cash flow. So I think that's one like common theme that these kind of names and Warren Buffett's criteria kind of follows.
Yeah, sure. Yeah, great comments. Yeah. So yeah, at the end of the day, like businesses are all like the present value of future cash flow. So yeah, definitely these are very durable assets.
Yeah.
Great.
Nice.
Yeah.
No, that's a great list.
Yeah, thanks. Yeah, and next on, we're gonna talk about some earnings releases that we think are notable and for the companies that we follow. So first on, I have something to talk about, like 2 companies right here. First is Aritzia. So really in their Q3 of 2024, Aritzia's revenue growth was around like 5%. And although that doesn't seem much, but this result was actually achieved on top of 38% in 23 and 63% in 2022 in the same quarter. So pretty decent result on a 3-year basis. And also the good news is inventory management is now under control, and inventory actually declined 22% compared to last year. And looking forward of fiscal year 2025, the company expects top line momentum to accelerate again. And if they can resume that growth rate compared to previous years, the stock could be re-rated higher from here. And also, another name that I think have pretty interesting earnings is TIH, Toromont Industries. So the company's report 9% revenue growth despite operating in a very challenging macro environment. And the company just actually raised dividends by around 12%. This is a 35th consecutive year of dividend increase. And they achieved this like over the time of like economic recessions like 08, 09, pandemic, and most recent one is inflation. Overall, the TIH has a very solid quarter, but this is a very well managed company, and we think like it's going to do well over long term for investors. Yeah.
Nice. Yeah, those are two high quality names. And it's interesting on Aritzia, like um they are certainly bouncing back. I mean, we have a plus 6% day today. They're up 6%. We're seeing some analyst upgrades, some price target increases from analysts, and this stock is really rebounding and just recovering so well over the past 6 months or so. I really think, yeah, that could be like a good comeback story for the next couple of years. It was such a high performing name for a while. Kind of got hit by those inventory issues, but now we're really seeing it bounce back. So it's a good story, and sometimes hanging on to these names that have fallen so much, and really having some conviction in high quality names. So yeah, that's definitely interesting. And Toromont, of course, another good name that we've been covering at 5i, and they've demonstrated solid fundamentals with good ROE, and so yeah, like you were saying, strong results, and they continue to grind higher. So yeah, that's awesome.
Yeah, sure, definitely. And also, Aritzia is like one of the names that our founder is really a big fan of.
Yeah, that's right. Yeah.
Yeah.
There's some good stories there behind the scenes for sure.
Sure.
Yeah.
And what companies are impressed you the most in the last earnings season first?
Yeah, definitely. So I'm going to add my chart to the screen here. So yeah, there's two names that I found had really impressive earnings results. And so the first is Tecsys Inc. The ticker is TCS. So TCS provides cloud-based supply chain services for a number of industries across North America. It reported Q3 results just late February, so late last month. And it reported earnings per share of 5 cents, which beat estimates of 2 cents. Revenues of about 44 million, beating estimates of 43 million. And we saw its SaaS revenue, so software as a service revenue grew by 48%. This included the addition of 5 new logos, 3 hospital networks, ongoing customer SaaS migrations, and it had the largest bookings quarter for its fiscal year so far. It's also been beginning to undergo a strategic restructuring, which they're expecting to improve profitability over the long term from this. And we're also seeing its annual recurring revenue increase by 16% in the most recent quarter. So, overall, this was a strong quarter for the company. Its share price has been, moving higher. We've seen momentum kind of, move higher in the past several months. And, overall, we like TCS because it operates in a niche sector of that supply chain software kind of market. Really caters to the healthcare sector. So I think this is something that TCS does a little bit better than Descartes, DSG, just operating in that healthcare sector. It's able to narrow and hone in on its focus of the hospital networks and kind of gain new traction and customers that method. So really interesting name there. We do see that its margins right now are a little bit thin, and they've been kind of heading a little bit lower, but it looks like we're getting close to an inflection point where they're going to start expanding soon. Like I mentioned, they have a restructuring in process that should help margins expand in the future. So if that takes place, I think that this name can just kind of continue to grind higher as profit margins improve, and we're obviously seeing strong earnings growth. So it's an interesting one. So that's TCS. And then my second name here, this one's been catching a little bit of attention in the Canadian markets. It's Propel Holdings. The ticker is PRL. This is a fintech company that operates through a few brands. One is MoneyKey. The other is Credit Fresh. These operate in the US. And then in Canada, it has Fora. So it reported earnings in March with Q4 revenues increasing 54% and EBITDA grew 62%. Its return on equity jumped to 35% in the quarter. And management overall targets 30+% this year. So I found these results pretty impressive. Overall, we believe the company's operating leverage can really help to continue to grow and expand these margins in the coming years. And, PRL's done a really great job of growing its services, growing the states and provinces that it operates in. And so that's really helped to drive top and bottom line revenue and profits. But also, it's innovative and, it's done a really good job of cost control. So we see those margins just expanding. And so it IPO'd sometime in 2022. We can see the blue line there. That's its price. It, kind of drew down alongside the markets in 2022. It based sideways for quite a long time. And recently we're just seeing as its earnings are growing, the market's getting to a more healthy place. Share price is kind of taking notice of that. And it also trades at a cheap valuation. I think it's about 9 times forward earnings right now. So pretty good for, a growing, rapidly growing fintech name. So yeah, interesting name there.
Yeah, for sure. Yeah, these two names definitely look interesting to me. Like for TCS, like I think investors start noticing the SaaS business that are highly recurring and growing 40+% a year is really attractive, and investors start to pay attention to that name. And also for Propel Holdings, is a very well managed like consumer finance company. Like return on equity of 30% and growing 30% is pretty rare. And trading is pretty cheap multiple too.
Yeah.
So I agree. I like both names pretty much.
Yeah, no, for sure. It's a good point. And one other thing that I'd like to add too is that I also like Propel because it's kind of like an addition to Go Easy. So, if an investor has like Go Easy in their holdings, they can kind of diversify into a slightly different name that operates in roughly the same market, but is more focused on the US side. And so, it's kind of like the two complement each other. They're both trading at, fairly cheap multiples, growing fast, and they're kind of, nice diversifiers against the larger Canadian financial names. So they offer investors kind of like a nice high growth financial tilt. So that's certainly another net benefit for Propel.
Yeah, sure. I agree.
Yeah. No, definitely. Yeah. So that was all that we had for today. It's FOMC day, so we've got the interest rate decision out. Markets seem to be moving higher. It looks like we'll see. That could always change. You never know. By the end of the day, things could completely reverse. But overall, the Canadian markets seem to be rebounding nicely here. So I think Canadian investors are in store. They've got a good year ahead of them in store. It seems like, the markets for the Canadian side still haven't made an all-time high. So I think that's maybe one thing that we can look forward to by the end of the year is maybe a new all-time high for the TSX. So who knows?
Yeah, sure. Yeah, that could definitely achievable. Like the rate, it did not even start dropping yet.
Yeah.
And so we still have like decent runway from here, I think.
Yeah. No, that's a good point. Yeah, it's funny. It's all about the anticipation, right? It really hasn't started to drop yet. We haven't had that monetary easing fully yet. I guess a little bit alongside the bond yields dropping, but rates are largely unchanged at 5%. So, lots to look forward to though. And so we hope that viewers like this episode, and that you learned something about the Canadian markets. If you want access to more exclusive content and insights, don't forget to visit our website at 5iresearch.ca and sign up for a free trial if you haven't already. You can find the link in the show notes below. And if you like the episode, please give us a thumbs up and subscribe to our channel for more updates. Thank you for listening, and we'll see you next time.
Thanks all for your time.